Okay, good morning and welcome back everyone to a Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week, a shortened week of trading because of Martin Luther King Day yesterday. Markets still on the S&P 500, just shy of the $700 psychological level or $7,000 level on the SPX. We're seeing markets over the last few weeks continue to approach this level, but fail to gather the momentum or to break out higher here. Overall, if you look at the economic data that's coming out, good news. We're getting economic data that's generally speaking relatively resilient, both from the labor market as well as retail sales and PMI. And at the same time, we're seeing that inflation data continues to trend in the right direction. That gives the Federal Reserve a lot more room to pause interest rate cuts rather. That has slowed down the momentum here for equities here to the upside. Now, the one thing that's important to look at here is if you look at the market cap indices, you look at SPY, you look at QQQ, you look at the NASDAQ 100, the indices that have been driving the markets higher over the last couple of years, have largely stalled. Look at the QQQ. We made a high back here in late October, and we have yet to exceed that level. And essentially, the market has been flat for the last nearly 3 months on the major tech companies that have been driving the markets higher over the last few years. So we've seen this sort of great rotation out of these magnificent seven tech names into the rest of the market. Interestingly enough, when you look at RSP, which is the equal weight S&P 500 index, which puts all 500 indices with the same weight. You see that over the last 3 months, the rest of the market is actually much stronger than the market if you weight it by kind of the Magnificent Seven. So interesting to see kind of that rotation, which is overall, generally speaking, healthy for market rallies. You can't just have five, seven, 10 companies drag up the rest of the market while everyone gets left behind. You need everyone else to play some catch up. And that's what we're getting at the moment is catch up. We're seeing it across the equal weight S&P 500 index. We're seeing it on small caps. If you look at IWM, this is all suggesting that the rest of the market is playing catch up, which, like I said, is a relatively healthy mechanism here for the overall equity markets. The only thing that probably concerns me the most at the moment are interest rates. You see TLT, the bonds continue to do quite poorly here over the last few months, which is why we're seeing 10-year yields back above 4.2%. Despite the interest rate cuts we've seen recently, interest rates have moved in the opposite direction. This is going to, in my opinion, put a lid on how far equities can continue to rally if interest rates remain stuck or continue to rise. We're seeing, the Japanese bond market over the last week or so show a fair amount of concern around the spending and debt levels of Japan. Granted, Japan's debt to GDP levels are higher than the US, but the US is not too far behind and are certainly starting to reach levels that, over the last few years have given investors some angst with regards to how much money the US government has to spend now to service its debt. And the fact that that debt pile continues to grow at a pretty significant pace every single year leads investors to be um, more concerned. And that's part of why we're seeing treasuries sell off rather than, participate on this kind of risk on rally. So interest rates remain, in my opinion, sort of the black swan event that we really need to make sure that we keep an eye out on. Because if U.S. Treasuries lose their sort of risk-free status, all hell kind of breaks loose. So this is definitely the bond market sending us some warning signals with regards to the direction that we're headed, and equity investors, in my opinion, better be paying attention to that as well. So looking at kind of what we are looking at here for the week, some ideas that I want to share with you, some new ones. Um, First one I want to take a look at here is Element Solutions. Now, Element Solutions is a materials company that is, generally speaking, not in most investors' radar. But recently, if you look at the stock here, the stock for the last 6 months or so has largely been range bound between 25 and 27 and a half. And you can maybe extend this range a little bit, between 22 and a half and maybe 27 and a half. And it's just been range bound here for, call it, the better part of 6 months. But recently, after being range bound, it just started to break out here to the upside. Now, Element Solutions being a materials company, which generally speaking are not household names, deals with chemicals. But recently they have been focusing on specifically and acquiring companies that specialize in the chemicals packages that are used in semiconductor fabrication, specifically the semiconductor fabrication methods required for these advanced chips, both from an Intel perspective, NVIDIA's perspective, stacking chips, or rather stacking transistors and gates on top of each other requires specific chemicals that companies like Element Solutions provide. And these are, I guess you could call it the building blocks of the semiconductor industry. And what's really interesting about Element Solutions is that it trades at around 17 times forward earnings, which is um, even for relative to the chemicals industry is a discount. Yet, if you look at growth expectations, ESI is expected to grow revenues at around 23% and revenues around 7%, which is a fairly significant clip higher than the industry. And more importantly, net margins at the moment are around 10%, but what I'm looking for is an expansion of those profit margins as it continues to focus on AI related chemicals packages that will drive margins even higher. So Element Solutions essentially is more profitable and grows faster than its peers, yet it actually trades at about a 10 to 15% discount to the industry. And that's what leads me to believe that there's a fairly significant upside here in Element Solutions. Now, the one thing I do want to point out here is that the options on on this stock is not particularly liquid. These options are the spreads on these options are very wide. So this is an example of a stock that I think better off for equity investors than trading options on them. Next, I want to take a look at here is Halo Pharmaceutical, or rather Halo Pharma's Therapeutics. Essentially, they deal with oncology drugs, cancer drugs. So a relatively small pharmaceutical company here, as you can see, the stock. It's been Generally speaking, if you look at a long-term chart, it is generally trending higher, but it's a pretty volatile, pretty choppy chart here. What I'm looking for is just the long-term trend to continue. Like I said, they deal in oncology drugs. What's interesting is that Halo trades at around 8 to 9 times forward earnings, which is basically in line with the industry. But if you look at growth expectations, we're looking at EPS and revenue growth that's in the 20 to 30% range. These things are always hard to nail down in terms of what future growth will look like. So I'm looking at this as a broader range, but we are talking about, strong double-digit growth that analysts are expecting. And then what's really, I think, important about Halo is the fact that net margins are north of 45%. And that's really where Halo far exceeds its industry. And for those reasons, I believe that Halo trades at a significant discount relative to its peers. Next one to take a look at here is Raymond James Financial, the asset management firm. We've seen last week with Goldman Sachs, with Morgan Stanley, the investment banking and wealth management sides of the businesses have been delivering really strong results, while the major kind of commercial banks have struggled a little bit. We saw JP Morgan, Bank of America, Wells Fargo, those types of commercial banks struggle a little bit, especially as consumers overall, while remaining somewhat resilient, are definitely showing signs of weakness here. But the investment banks, the ones that are focused on commercial clients, not commercial, enterprise clients and deal making, those are the ones that are doing quite well. Specifically, the wealth management divisions generating a significant rise in profits. So firms like Raymond James are ones that focus predominantly on wealth management, and I expect firms like Raymond James to do quite well in this type of environment where equities are essentially at all-time highs. A lot of asset classes are doing incredibly well, and I believe fees from the wealth management business will deliver a fairly significant jump in profits for stocks like Raymond James. So when you look at the fact that Raymond James essentially trades on par with its industry, even though growth expectations and profitability are largely in line, that's really where I think Raymond James has the potential here to break out above this prior high around 175 to the upside on earnings, which is coming up in about a week's time. Um, the next one to take a look at here is Block. If you look at Block, Block has been, uh, this is a stock that really took off here last year. Um, and then, went from, a $50 stock to basically a $100 stock in a relatively short period of time, and then gave it all back here towards the beginning of this year. It kind of struggled a little bit here earlier. It did manage to kind of complete this bottoming formation, traded all the way up to around 80, traded sideways, and then failed here again. But now it's starting to slowly work its way back up again. And that's really what I'm looking at here right now is the slow trend higher here. It's a slow move to the upside, but we're making higher highs and higher lows, and now we're at the back of the bottom end of that trading range. And as you can see, it's just generated a bullish trend following signal here, and that's our a timing model to look at buying some upside here in XYZ. But if you look at the fundamentals here, Block trades at about a 10% discount to the industry, yet growth expectations are coming in a fair bit higher than the industry. We're looking at EPS growth that's expected to be in the 30% range versus the industry is around 10%, 10, 11%. Revenue growth is essentially in line with the industry at around 8, 9%. And then profit margins are actually higher than its peers, 13% versus 10%. And profit margin is really where XYZ or Block has significantly improved their outlook. Their focus in the last year has been solely on growing bottom line and profit margins, and they have not only delivered on that, they've exceeded their initial targets for the timeline for delivery of that. So, Block, which was formerly Square, the symbol used to be SQ. They've not only rebranded the company to Block, but also changed their symbol to XYZ. So if you're not familiar with that symbol, it is the former Square company, and they've been doing a fairly decent job at executing on combining their two primary ecosystems. They have their Cash App, which is more popular amongst younger consumers as their kind of banking slash credit needs. And then you have a Square, which is the obviously the payment processor for millions of small businesses and whether it's brick and mortar or e-commerce, Square powers a significant percentage of small businesses credit card processing, and combining those two ecosystems is what they've been focusing on, and they've been executing well on that and delivering on both growth and profitability. So the fact that it trades at a 10% discount to its peers leads me to believe that there's a fairly significant upside here in XYZ, and the market timing on it makes sense to take a look at adding some bullish exposure at these levels right now. The next one I want to take a look at here is NVIDIA. NVIDIA has been trading sideways for a little, whoops. NVIDIA has been trading sideways here for a little bit of time, but I still want to make the case here for the fact that NVIDIA trades at 24 times forward earnings, right? The stock has essentially been flat for essentially 6 months now. But it trades at 24 times forward earnings. And growth expectations are in the 45 to 50% range. So we're expecting revenue and EPS growth to come in around 50% year over year. There's just really no company that holds a candle to that type of growth. And more importantly, on top of that hyper growth, they are what's the right word? Hyper profitable as well. Profit margins are north of 50%. So you're talking about growing at 50% year over year while maintaining 50% profit margins, yet it only trades at 24 times forward earnings. I could find you probably close to 100 stocks in the S&P 500 that's trading north of 24 times forward earnings that have growth expectations and profitability that is far, far, far behind NVIDIA. So the fact that this stock is trading at 24 times forward earnings, I think represents one of the most undervalued stocks in the markets at the moment. Another one to take a look at here is a more of a stock play rather than an options play is Corpay. Again, not a household name, but if you're in the enterprise business perspective, Corpay is building themselves into an interesting corporate payments platform. They used to be Fleet Card, which is a gas card company. And they've been working very hard to shed that gas card company history because the stock trades at 12 times forward earnings, 13 times forward earnings, which reflects more of a gas card company multiple. But as they focus more on enterprise payments, specifically for businesses to manage their cash flows, their expenses, and their travel management. You're seeing EPS and revenue growth in the 13 to 15% range. So we're talking about respectable double-digit growth year over year for both revenues and earnings. But what's really interesting about the company is that profit margins are 25%. That's more than double the industry. Yet it only trades at 12 times, 13 times forward earnings, sorry, versus the industry is around 21 times forward earnings. So the industry doesn't grow as fast, it's not as profitable, but trades at 21 times forward earnings. Corpay at 13 times, I think, represents really undervalued stock here. But because of the liquidity of the options, you need to be more careful. As you can see, the spreads on the options are fairly wide. Um, Another one I want to take a look at here is Akamai. Akamai, as you can see here over the last couple of months, have started to reverse this long-term decline that we've seen in this particular stock, right? The stock has been in a long-term decline, started to pop higher here, traded sideways, and now is starting to pop higher even further. So essentially completing this long-term bottoming formation and now starting to work its way higher here. Akamai is working very hard on, similar to Corpay, shedding its history, its past. It focused on content delivery networks, which in the days of streaming was a very important component to being able to deliver streaming services to customers with low latency and speed. But as that business becomes a very commoditized business, Akamai has been rebranding itself and refocusing its business on the edge compute needs that these large language AI models require to be able to provide results to users in a performant matter. So if you think about, requesting your ChatGPT prompt, being able to run those large language models closer to the end user to be able to deliver the results in a quick fashion is really what Akamai is focusing their cloud technology on. So the company, as you can see, is starting to grow their earnings and revenue, but that's really the part of the business that's lagging behind. And as they focus their business on this, investors are starting to show some signs of turning things around. But they still need to deliver on the actual growth. They've been focusing on shifting priorities for their business. Now they need to prove that they can win over customers. So this is a more, I would say, early speculative play, but that also makes the upside potential fairly significant in my opinion. It's trading at 13 times forward earnings, similar to Corpay. The industry is closer around 21 times. So you have a lot of room to grow to here to the upside. But that will only happen if they can show that they can secure enterprise clients for their cloud network that they've been building. So we'll see over the next few quarters how that plays out. The price action is showing that investors are starting to pay attention. And the question is whether or not this starts to take off higher here as they prove out their new model. But I think it's worth keeping an eye on in the short run. And then on the flip side, taking a look at some stocks that I think are worth taking a look at here. Cloudflare remains our top bearish stock here at the moment. Cloudflare is trading at about 150 times forward earnings. And if you look at this chart here, you have this massive topping formation that's kind of with the neckline around $180. That you can draw your lines however you want, but this looks like a classic sort of head and shoulders type pattern here, with the 180 level being the neckline. Now, the neckline has not broken yet, right? So this level has not been broken yet, but tension is continuing to build, and this downside continues to get tested. This 180 level has now been tested 3 times. If it breaks below here, the downside fairly significant, and Cloudflare trades at 150 times forward earnings. It is just trading uh, at valuations that are in the atmosphere. Growth expectations are decent here for Cloudflare. We're looking at about 30% EPS and revenue growth, but the problem with Cloudflare is that it's not profitable. They spend nearly every dime on marketing and customer acquisition. So while they're growing very fast, they don't make any money. And the problem is that Microsoft and Azure and AWS are starting to add some of these types of cloud security services natively into their cloud for free to their customers, which is likely going to be a erosion in Cloudflare's ability to continue to grow. And then for those reasons, I think with the crazy valuation it trades at, Cloudflare represents one of the most um, significant downside risks that I see here in the overall market. So with that, that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of where we currently stand in the macro picture here for the equity and bond markets and what are some specific opportunities what we see here right now in the markets. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.